Hey everyone, it's John Pocoroba with Rain King LLC, and it's time for a general market update. It's March 17th, 2023. As a reminder, I'm an amateur individual growth stock investor. I'm not affiliated with MarketSmith or IBD. So, March Madness. You thought it was all about the NCAA tournament. Certainly, we're seeing a lot of crazy things in the market this week, a lot of activity, and we're going to delve into some of the details. So we're going to start with the market internals, then we'll cover the current indices, and then we'll try to wrap up with a quick summary and where do we go from here. So the market internals. I just wanted to start it with this economic cycle ring diagram, and also shows the economic cycle versus the stock market cycle on the left. You'll notice in the ring diagram, it's hard to tell exactly where we are on this wheel. We know the economy peaked out probably back in 2021. We've had a bear market for a year. You'll notice at the peak, the sectors that were performing, financial, energy, and materials, they've all fallen off, and we're going to talk about those. Talk of recession, we don't know if we'll have one or not, but that's just speculation. And then you throw in the banking crisis, and it's a little unclear where exactly you are in the cycle. But let's try to break it down. This is actually a comparison chart from January 12th when we had the breadth thrust. And just looking more recently, if you look at the performance from early March, look at the sectors that are outperforming. We have the XLK, we have the QQQs, and we have the XLC communications ETFs. And as I mentioned, the sectors that are really underperforming, energy has been declining, financial have been hit hard the past couple of weeks, and materials. So those were late cycles elements and sectors that are starting to really weaken in the market. So we're seeing rotation. We're seeing rotation from some of these sectors, and believe it or not, they're going into some of the other sectors that are more growth oriented. So if we look at this a little closer, and this is a comparison of the XLK, which is the technology ETF, divided by the SPY, the S&P 500 ETF, you'll notice that technology has been outperforming very, very strongly since the beginning of March. So strong outperformance. We have not seen this kind of outperformance in quite a while. It started way back at the beginning of the year. We had a major thrust, and we kind of chopped around a little bit with a pullback, and then technology has certainly been outperforming with the surge, with money starting to flow into some of the mega caps, almost as a flight to safety relative to the banking sectors and the financial sectors. So that's why the mega caps like Apple and Meta and Nvidia, et cetera, are starting to get more money flows. So this is the New York Stock Exchange net new highs minus new lows. And, the picture's not as great. The internals are still far from what we'd want it to be. We turned almost 2 weeks ago from net new highs down to net new lows. They really expanded. Though they've dried up a little bit here, they're not to the level we'd like to see. We'd like to see this dry up even more. You can see the past week, this box hasn't been seen for quite a while going back. So the net new highs, new lows is not a positive yet in the market. Advanced decline lines. This is showing the New York Stock Exchange on the left. And you can see if you just draw a simple downtrend line, we had pushed out higher early in the year. Things look really good. We talked about the pullback being normal. Then last week, I think we said, this pullback is not looking normal. And with the financials being hit, you can see the S&P is kind of flirting with this trend line, trying to get some support in here. So we'll have to see how that plays out. Now, the NASDAQ's advanced decline line is not doing well. It's actually, believe it or not, it's hanging down around the lows that we had at the beginning of the year. So this is not a positive sign on the internals of the market, even though we see the QQQs and maybe the NASDAQ composite putting up more of a fight. So I tweeted this out yesterday because we had a strong rally yesterday, sharply for almost half the day. And at the end of the day, though, I think I tweeted out that it was under the surface was not as great as what the headline gains were. So I threw up 3 quick charts. One was the NASDAQ, and yesterday we did not get a follow-through day. We also noted that the QQQs had a very strong day, but if you broke it down, there were actually, I think, 4 stocks that accounted for half of the gains. I think Microsoft alone was a major component to the gains, NVIDIA, and maybe Meta was the other one. So, that looks good. But then when you take the QQQs and you weight them equally, not by their market caps, you can see that the QQQ equal weight is actually underperforming and lagging. So again, the broader market is not as strong as some of the headlines, which are dominated by the big tech stocks. Now let's look at the current indices. So I pulled this slide from the the February 10th slide, and I was showing a comparison of the 1962 market to today's. And at the time, the S&P, we had come down to the October lows, and we had made a rally, and we said we were retesting the October lows, and we were just starting to push higher as we started the year. And we were kind of comparing a precedent with how the 1962 market bottomed, which again had similar 3 waves down. As you can see here, there was washout selling on the second wave down. And you notice that I believe that we had our washout selling on the second wave down, which was June. The weekly new lows that week were 50% of all names that were traded on the New York Stock Exchange. So it was a very big washout, and some real high numbers of new lows. But 62 market had a rally, and things were starting to come back to a normal pullback, and then things were starting to stabilize on the retest. And then the Cuban Missile Crisis occurred, and it created this very sharp break in the market, where the market tested its previous lows in October by coincidence. And finally, when this was resolved, when the Russian ships turned away from Cuba, the market had a sharp rally higher. And I guess we were here. Now, if I update this chart to today, we've had the situation where we bottomed in October, we came back in December and had a retest, and then we were trying to start basically an uptrend, and we got turned away, and we're amidst this banking crisis, which has created lots of uncertainty. And the question is this going to be a similar retest, a retest of the December lows in this case? And maybe it's possible that once this gets resolved and some of the fear comes out of the market, do we get a sharp rally to actually have a bull leg in the market? That's a possibility. The Fed's coming up, so we're going to talk about that in a minute. But when you look at this weekly chart, what's interesting is look at the blue spikes. We got 3 blue spikes since the beginning of the year, almost 4. That's very positive. That's not distribution. Those are actually accumulation weeks. So even despite the very bad week last week, you'll notice that the volume was less. So it's encouraging to see that the profile of price and volume on a weekly basis is actually turning more constructive, versus if you look to the left, you can see all kinds of distribution red weeks. So in summary, the volatility has certainly picked up amidst this whole banking crisis. An uncertainty creates fear, and the VIX will rise, and you'll get much more volatility. So we have to keep our tabs on that with the Fed meetings coming up on Tuesday. Last week we were talking about a 50 basis point hike. Now the odds have changed amidst the banking crisis. They're talking about the odds of a 25% basis point hike of being 69%. And now there's talk of maybe there's a 31% chance that the Fed will pause and have no hike at the meeting on Tuesday. So it remains to be seen. No matter what happens on Tuesday, the most important thing is just to watch for the market's reaction and stay away from the news headlines. Just as a reminder, the news is going to be the absolute worst at the market's bottom. So it's been a volatile week. It's been a fearful week for people with the bank collapse of the couple of banks, and there's a few more that are potentially out there as worrisome. So it's interesting. You have to wonder if the markets are less worried about a potential recession 6 to 9 months, because we are seeing bond yields decline. They've been coming down fairly quickly. So is that a signal that the market is looking out 6, 9, 12 months and saying maybe there's going to be rate cuts 6 to 9, 12 months out? So we'll have to see how it plays out. It's an interesting meeting on Tuesday. We want to see the reaction. That's what will be really most important to us. We're trying to understand yet, is this just a relief rally we might get here in the indexes, or is this something that might have some bull legs to it? At the current moment, the risk to me really outweighs the reward. There's a lot of risk and uncertainty, and it's just not the type of market where I see a lot of reward unless you're a very nimble trader. But what you should be doing, what you should be considering right now, what's important, is you need to freshen your watch list, because you need to be ready. If things turn quickly, like we talked about in the 62 market, once there's more clarity, things could really change dramatically. So this week, I'm just showing you some watch list ideas, stocks that I think are fairly interesting to watch. They either in bases, some of them are actually out of bases. Some of them are acting really well amidst the volatility in the market. A couple of them, NVIDIA has been extremely strong, and Annette has been very strong. A number of them have been very solid. Other ones are consolidating out of gaps. That's a positive sign as well. So that's a few names to maybe look into. None of them are recommendations, though. So the second thing really is a batch. What are we looking for? At least the way I'm approaching it, I really want to watch the breadth of the market, particularly if we see the indexes rising like we did yesterday. I want to continue to get under the surface to see if the breadth is good. We are seeing rotation. We saw that. We showed how the energy sector is coming down, financials and technologies areas of the market are starting to see some accumulation. Now, we want to watch net highs, new lows. Right now, the profile is not good. It's a negative. We want to see that improve before we start to put money to work. And we should be watching out for a follow-through day. And a follow-through day would be on day 4 or later of a rally attempt. So we want to be patient. We want to pay attention to the market. And, I put a lot of weight into those last 3 bullets. Those things have to improve to a point that it tells me it's okay to take a shot at some names in the market. And I'll end with this quote: keep very few indicators, but trust the ones you keep. That's by Justin Mamus, and he's a market technician, no longer with us, but has some great books I mentioned on the podcast. I think it's really true. You have to really believe and have your indicators tested. You believe in them. And as I just mentioned to you on the previous slide, that's what I'm looking for. I want to see those turn positive to the point where I would want to get back into the market. So as we wrap up, I just wanted to again, let people know about the earnings reaction gap workshop that myself and Jason Thompson at Ticker Monkey are putting together. Registration is open, and we have an early bird registration that expires this Sunday night at midnight. The workshop is chock full of great stuff. I'm not saying that because I'm part of putting it on. You can see some of the bullets on this slide. There's a lot that went into this workshop, and the data, the research, lots of annotated charts. I believe we have over 117 examples and templates to help you with understanding the concepts. And if you haven't gone to tickermonkey.com website, ERx Gap Workshop, I have posted on my YouTube the 7-minute promotional video, which gets into the workshop details and how you can register. We're offering 2 ways to participate in the workshop. So I'd encourage you to seriously consider that, because I'm a big believer that when the bull market really starts to unleash itself, there are going to be growth stocks have gaps, and they're going to have earnings surprise, and that's going to lead to a lot of momentum. And you want to be prepared, and I believe you really need to do that right now to get ready and prepared. So that's the general market update for March 17th, 2023, and I'll see you on the next update.